Hi there, folks. I'd like to introduce our second session in our series of videos by reintroducing myself. My name is Joe McQuaid, and I'm a principal at Wealth Preservation Associates. And more importantly, a person probably just like you, concerned about retirement. Like most of my clients, my wife and I do not have $1 million in the bank, but we do want to have a comfortable retirement. Again, like most of my clients. What I do is I focus on conservative insurance-based solutions. Solutions that I have actually utilized for my own retirement needs. So I do not have to spiel the insurance company marketing pitch. My own personal experiences are what will allow me to share with you advice on some options that may work for you. And I also agree with many of the pundits out there that there is no single product or single solution that is the holy grail of retirement planning solutions. What we have are appropriate solutions based on timing, financial situation, and overall retirement objectives. Now, if you recall, and if you had an opportunity to see our first video, we talked about the definition of the fixed indexed annuity. And we went into some detail on each of the individual parts, so we're not going to cover that again today. And if you need more information on that, as always, we ask you can contact us by filling out our form on the website or by giving us a call. We would be happy at any time to sit down and hold a complimentary consultation with you to show you what options are out there and to hear what your needs, goals, and objectives are, because that's what it's all about. Until we actually know who you are and what your needs are, none of these products necessarily will be a fit, or all of them will be a fit. Today, we're going to concentrate on one portion, one option in a fixed indexed annuity. And it really doesn't matter the insurance company. I picked this particular option because it has a multiplicity of different variable options that we can utilize to not only help our clients to make sure that their guaranteed lifetime income is there, but in the event they have some needs for long-term care, or they have no need for income, no need for long-term care, and they want to make sure that they have some reasonable growth for their beneficiaries, who at the end of the day would be the recipient of the death benefit should they pass away without having to use the annuity for any of the options that they have. So today we'll concentrate only on the one option, which is the income rider. In our next video, we're going to talk about the long-term care option, and we're going to talk a little bit more about the family protection or the death benefit option. So let's take a look at what we put together here. This document is known as an illustration. The illustration was put together for an unknown valued client, and in this particular case, I am the representative for that client. We're in the state of Florida, and the name of the product is the Personal Protection Choice. But as I say, there are dozens of different annuities out there, and within each of those annuities, there are dozens of different options. So the combinations are numerous. And it would be based upon what the client is looking to achieve, what their goals are, what their needs are, which combination of product and options that we would try and put together for them. In this particular case, we have what's called an income tomorrow solution. I am going to talk to that in a little bit, in a few minutes, to kind of tell you what the difference is between tomorrow and today. Those are the two options that are available in this particular income rider. It's a single rider option, simply means it's paying income to one life. This can be set up for couples to pay a joint survivor payment, which would then pay for both the husband and wife. And when one of the spouses passes, then the income would continue to come to the second spouse until their death. In this particular case, we're using the single option. The premium amount we're depositing is $150,000. The years to defer until rider exercise is 8 years. Now, in this particular case, that's important only to show the summary here of what the output would be when this particular rider option was exercised. Now, this rider option can be exercised at any time during the 10-year contract life of this particular annuity. The annuity does have a 10-year contract life, and you can start to take that income whenever you would like to. So let me describe it a little bit by going to this column here. This is the column that we are going to concentrate on today. When I refer to the income box and call it income tomorrow, what that suggests in this particular offering, the insurance company is guaranteeing a 14% interest rate growth year after year until the owner of the annuity exercises the income option. So in this particular case, the premium would grow to $318,000 for purposes of taking income, and I do emphasize that because this is not the accumulation value of the annuity, which I'll talk about in a minute, but this is the guaranteed minimum withdrawal base. So this is the guaranteed amount from which the income is going to be drawn. In this particular case, the option was exercised in year number 8, so the total amount was $318,000. The annual income is $12,338. Now, the way we arrive at the income number is based on the individual's age. In this case, they're 60 at the point of taking the annuity. They're 68. They have exercised it in the 8th year. At 68 years of age, there is a certain percentage of the guaranteed base that the insured would be paid. And in this case, it's a 4% payout on the guaranteed base. So that amount would be paid for the rest of this individual's natural life. If they live to be 104, they would still continue to get this money year after year. Now, as I did say, and I'm going to segue back to the income column here, I said income tomorrow. There is an option as well for folks who want to accelerate the time in which they're going to be taking their money. They call it an income today option. And all that really happens, the difference with that, is that the amount of interest paid over the first 3 years is accelerated. And in year 1, it's a 30% interest payment. Year 2, 37.5%, and in year 3, a 45% interest payment. And that allows this base to grow very, very quickly, so that there's a significantly higher number in the 3rd year. Now, what does happen after that is the amount of interest paid trails off to 3% a year throughout the rest of the 7 years of the 10-year contract. So the crossover is about 5 years. If you think you're going to take 5 or more years of growth before you take income, you certainly want to take the income tomorrow option. If you think you're going to take the money within the first 3 or 4 years, then the income today. And that's, again, in this particular product. So, as we can see, this client is now assured and will know exactly how much money they'll get year after year by setting up this product. And, of course, this indicates that they will not take out any withdrawals, which they can do. They can take out penalty-free 10% withdrawals after the first year. So if they do need the money earlier, rather than taking it as an income stream, they can take it as free withdrawals. If you take more than the 10%, there is a penalty. So that's something we want to avoid. And as I always suggest to my clients, annuities are wonderful products when you're putting it into a long-term plan. If liquidity is required, an annuity is not the solution. As we said earlier about no one solution is the holy grail. If you need liquidity, then you're looking at things like savings accounts, money markets, brokerage accounts, things where you can get at the money quickly, you can liquidate the account quickly and get your entire principal back. If you are looking at this to be your retirement plan, if you will, and your lifetime income plan, then there is no better product than an annuity. Now, in closing, before I move off, and just to let you know, we will be talking in our next video about these other columns, not going to get involved in those today, but they are critically important, particularly for those folks who are worried that long-term care may become an issue for them down the road. You certainly want to see our next video. But before I leave, I do want to talk for a few seconds about the accumulation value. Accumulation value is independent of the guaranteed minimum withdrawal base number. It is the growth that will take place in that annuity year after year based on the market condition and the investment options that you make. As we said in our first video, you can choose to go into a fixed interest rate, or you can choose a fixed interest rate and index options, S&P 500 indexes. In this particular annuity, other annuities have a myriad of index options, including Dow Jones and NASDAQ. So we don't know from year to year how well or poorly they're going to do. What we do know is that when they do very poorly and it's below a 0% growth in a given year and it's a negative growth, that you will not feel the pain of that negative growth in a fixed indexed annuity. You will only get a portion of the positive growth. And that is the basic concept and commitment of a fixed indexed annuity. So today we talked about our income rider. Hopefully the information was helpful. We would certainly like to hear from you. Please get in touch with us through our website by filling out the contact form, and we'd be happy to set up a complimentary consultation with you and your family to see how we can implement either this type of solution or other types of solutions that may work for you in your portfolio. Joe McQuaid, thank you for visiting us today at the Wealth Preservation Network. We hope to see you again soon in our next video, and happy retirement planning. You have a wonderful day.